using innovative tools to dynamically manage risk. The ability to use dynamic rebalancing to control volatility exposure can present opportunity to manage risk. Advances in volatility-based benchmarking have paved the way for new indices with dynamic leverage and weights designed to help maintain a predetermined level of annualized volatility, decrease potential leverage during high volatility periods, and systematically manage risk throughout the week. The S&P 500 Futures Edge Volatility Indices are a next-generation family of volatility management benchmarks that measure the performance of leveraged dynamic weighting strategies applied to the S&P 500 Futures Index. A key characteristic of this series is the edge component that employs a forward-looking estimation of volatility that is calculated daily to help the indices adapt more quickly to changing markets. The S&P 500 Futures Edge Volatility Index series taps into the trading ecosystem of the S&P 500 through indexed options and futures, which allows the indices to partially rebalance on each weekday. The indices dynamically adjust their S&P 500 weights up to a leveraged 500% to increase potential equity upside when volatility is below its target and decrease exposure to the S&P 500 Futures Index when volatility is higher. How do the S&P 500 Futures Edge Volatility Indices work? Each benchmark within the S&P 500 Futures Edge Volatility Index series is composed of 5 component sub-indices, each of which rebalances on a different weekday to help them diversify risk across the entire week. The forward-looking volatility metric analyzes the entire chain of weekly S&P 500 options expiring on the same day of the following week. This feature seeks to enable the indices to respond quickly to volatility increases based on market expectations while still targeting a predefined level of volatility. Intraday data is applied at a fixed interval for implied volatility calculation using S&P 500 weekly options to determine leverage. Additionally, to avoid any potential end-of-day trading congestion associated with the options and futures index components, the indices rebalance intraday between 12:50 and 1 p.m. Eastern using a time-weighted average price of the underlying S&P 500 Futures Index. The S&P 500 Futures Edge Volatility Indices target an equal weight exposure to each sub-index based on the weekly rebalance and the leverage change in levels for non-rebalancing components. Each sub-index has a built-in mechanism that seeks to floor the level at 25% of the prior week's rebalancing and applies leverage of up to 500%, which may contribute to increased potential equity upside. Let's dig deeper into how this works. Weekly leverage for each sub-index is determined as the minimum of the leverage cap and the ratio of its target to forward-looking volatility. As a result, when implied volatility is below 35% or 40%, the respective target exposure to the S&P 500 futures increases to a leveraged position of up to 500%, and it deleverages when implied volatility is above the target. The weekly systematic rebalance can influence performance depending on the day of the week it's implemented. By equally weighting exposure to each sub-index, the S&P 500 Futures Edge Volatility Indices may help to reduce such a variance. The S&P 500 Futures Edge Volatility Index series includes 4 indices which target volatility levels of 35% and 40%, 2 non-decrement versions, and 2 with a decrement of 6%, which deducts a fixed percentage from the index on an ongoing basis. To learn more about the mechanics of decrement indices, please watch our video, Deciphering Decrement Indices. The S&P 500 Futures Edge Volatility Indices with the 6% decrement overlay may create more price-efficient indices, which may in turn help issuers seeking to deliver specific terms at the structural level. Those terms may include higher index participation rates and potentially improved downside protection. However, a potential trade-off of this index design could be consistent underperformance of the underlying index if the decrement deduction is materially higher than inherent dividends theoretically paid out from the index. So how have the indices performed based on back-tested data? Since July 2013, the S&P 500 Futures Edge Volatility Indices would have all outperformed the S&P 500 Futures Index based on back-tested data, albeit with higher volatility by design. Back-tested data also shows that during previous volatility spikes like those in March 2020, the indices reduced S&P 500 futures leverage based on the forward-looking estimation of volatility, which would have theoretically helped to stabilize index volatility to its respective targets. To learn more about how the S&P 500 Futures Edge Volatility Index Series seeks to dynamically manage risk with a forward-looking volatility component, visit us at the link below.